Uh-oh, we're in a serious dilemma. Over the past year, all of your cash savings lost almost 9% of its value due to inflation. But if you took that same cash and invested it into the S&P 500 instead, from July 22nd, 2021 to July 22nd of 2022, your money would still be down around 9%. It's about the same. So what exactly should we do? Everything seems to be losing value, and it seems like there's nowhere to hide. Historically, investing in the stock market has been the better alternative to grow your wealth long term when compared to holding cash. But investing in the market seems super scary right now. As one investment manager put it, you make most of your money in a bear market. You just don't realize it at the time. A lot of us are trying to figure out what to do right now. So in today's video, we'll be talking about how much cash you should invest and how much cash you should save. Okay, so if you're anything like me, you probably check your portfolio way too much. Pretty much every day, right? It's like going on an emotional roller coaster every time you open your phone. You experience this excitement as your investments go up, only to feel complete devastation when they come right back down. It's terrible. Investing is just emotional overall, but emotions can negatively impact your decision making and your portfolio. Imagine you're in a major bull market. The market is going up every single day, and it doesn't even matter what stock or ETF or fund that you buy. Everything's going up. You decide to buy riskier stocks that are going up 2 times more than the overall market. But the high risk doesn't matter, right? Because after all, you're outperforming the overall market, right? The major indices. Then all of a sudden, everything changes. Inflation gets bad, and the economy starts really slowing down. The market is not going up anymore. In fact, it's coming down fast. Remember those stocks that were going up 2 times more than the overall market? Well, guess what? They're now going down 2 times more than the market. Months of painful declines go by, and you finally decide to cut your losses and wait for the market to bottom before you reinvest. Well, it just happens that the day you sold was the day the market bounced back, and the stock market started its next bull market run. Now, this story isn't actually real. Well, it kind of is, right? It might seem a bit too familiar for some of you out there. Investing with too many emotions can lead to poor decision making, and in our example, we get too greedy when the market went up and too scared when the market went down. Many people are overly emotional investors, more than what they would care to admit. So how should we fight the urge to be emotional investors? Fighting emotional decision making actually brings us to how much cash you should invest and how often you should invest. Maintaining a disciplined investing strategy can prevent emotions from taking over whether the markets are up or down. Always remember the big picture. Zoom out. What is the end goal and how much money will you need in order to accomplish that goal? You should start with this question because having the end goal in mind can help keep things in perspective when the market and economy fall, and you will experience those downturns. And when you invest your money, it's important to invest for the long term, not for the short term. This is because the markets are super unpredictable in the short term. But as time goes by and as you zoom out more from the history of the market, it gets a little more predictable the longer time frame that you have. You should only invest money that's meant for at least 3 to 5 years from now. Depending on your current situation and how soon you want to reach financial freedom, the amount of money that you should invest will differ. Take, for example, the 50-30-20 rule. It's one of the most popular budget rules out there. With this rule, you divide up your after-tax income and then allocate it to 50% on needs, 30% on wants, and 20% to savings. This is a great starter budget if you've never budgeted before. But if you're doing well with keeping your finances on track, 20% to savings and 30% to wants is kind of conservative. So if you've been investing around 20% of your after-tax income for a while, try increasing that percentage to 25% and then lower your wants allocation back down to 25%. As time goes by, see if there's any noticeable changes in your lifestyle. If not, keep increasing your savings rate going forward. When I first started out with the 50-30-20 rule, I noticed that spending 30% of my income on wants was a bit overkill. So every month I was lowering my spending on the wants category, and before I knew it, I was only spending 15 to 20% on wants and investing 30 to 35% of my income. I realized that saving more money was actually more enjoyable than spending that money because I could see more of my net worth and investments growing, and that motivated me to save more. Compounding became even more real. That being said, this strategy will not work for everyone. So I'm not saying to live like a Scrooge or live super frugal in order to invest more. Life is short and you should enjoy it, but having a budget and sticking to it can bring some peace of mind about the future. The bottom line here is to have a consistent and eventually increasing allocation of your income dedicated to that savings. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Once you determine the ideal percentage of your income dedicated to saving, how do you know when to actually invest your money? This is typically the number one question that beginner investors face. They're ready to invest, but they cannot decide when to actually start. Trying to time your investments is extremely difficult and is something that even professional investors have a lot of trouble with. Most don't. In fact, a 2017 study from Boston College found that target date funds that tried market timing underperformed other funds by around 0.14%, which led to a 3.8% difference in returns over 30 years due to compounding. Doesn't even talk about fees, too. Morningstar found that less than half of the actively run funds actually outperformed passively run funds. As legendary investor Peter Lynch put it, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost on corrections themselves. Think about that one. If you're trying to find the perfect time to invest, you're likely going to face worse outcomes. The key to investing is taking advantage of time, not market timing. And with time, your goal should be to start ASAP and let compounding do the rest. Time in the market is one of the most powerful ways to increase your returns because of the way compounding works. And when you wait to invest, you give up time in the market and your returns have less time to compound. If you zoom out and look at the market's historical performance over a long period of time, the trend is very clear. It goes up. If you wait to invest, you might succeed at finding a relative low point, buying on the dip, but in the meantime, history has shown that you'll miss out on a bunch of good days when the market was rising. You're also likely to miss some of the key market days that have an outsized impact on your overall returns. Typically, the market bounces back really quickly in a short amount of time. On the other hand, if you put money in the market as early as possible and keep adding to it over time, you can potentially benefit from the overall upward trend, not to mention the time you'll save by not monitoring the markets too closely. I could save a lot of time doing this. This also means you won't wait around with your excess cash in a bank account where it's likely to even keep up with inflation. For these reasons, we suggest taking the market timing factor out of the equation and looking into dollar cost averaging. According to Investopedia, dollar cost averaging refers to the practice of systematically investing equal amounts spaced out over regular intervals, regardless of the price. Dollar cost averaging can help reduce the price volatility of your target investments. Here's how it works. If you put your money into the stock market all in one day, there's a pretty high risk that bad timing could hurt you. But if you were to invest a certain amount of money each week, regardless of if the market is up or down, you could smooth out the average cost of your investments. If the market is down, you get to buy more shares with that fixed amount of money. And then when the market is up, you get to buy fewer shares with that same amount. Over time, you could get a better average entry price than if you were just trying to time the market. Now, obviously, it's easy to say just keep buying and dollar cost averaging when the markets are doing well, right? That's easy. But it's a lot harder to say when the markets are down and fear is just taking over everywhere. But don't worry, dollar cost averaging has the potential to work in any market, even the worst ones in history. Back in the mid-60s to the early 80s, it was a difficult time to be an investor. Inflation was rampant and the market was having a rough time. Even after reinvesting all dividends and adjusting for inflation, the American stock market would have lost you money for 16 years straight, the longest loss on record. If you invested $1 into the S&P 500 on February of 1966, that dollar would be worth 95 cents by October of 1982. Yikes. But this example was a one-time investment, and ideally, you wouldn't invest just once and then wait for 16 years to invest again. So what if you invested $100 a month throughout those 16 years of high inflation and stagnant returns? According to a study from Returns 2.0, instead of losing money, you would have turned your $20,100 of total investments into $20,931, adjusted for inflation, by October of 1982. Even in one of the worst inflationary periods ever, dollar cost averaging into a terrible stock market still preserved the value of your money. In markets like today's, no one knows where the bottom is or when the market will rally again. Maybe by the time you watch it, this is already rallying. So why not just invest anyways? Although past performance is not indicative of future performance, gotta say that one, and there are no guarantees, gotta say that one too, history has shown investing consistently can work, even in the worst markets. One easy way to dollar cost average is to invest every time you receive your paycheck. So whether that's weekly, bi-weekly, or monthly, just calculate the percentage that you want to invest and remember to do it consistently. If you're investing with Wealthfront, we've automated the dollar cost averaging and you can set up regular investments at consistent intervals with just a couple taps. It's incredibly easy. However, remember that dollar cost averaging only works out well if the market rises in value over the course of your investment horizon, which it likely does if you have a long-term horizon. Dollar cost averaging can help improve your investment returns when markets go up compared to trying to time the market, but it can also lead to losses in the short term if the market continues to go down. You just gotta think long term. Even though continually investing into a bear market is difficult, you might think of falling markets like a big sale. If you need to buy more stocks, let's say, and there's a 20% off stock sale, you don't rush to throw away the stocks you already own. Instead, you'd probably go out and buy some more stocks at a discount. If only stocks accumulated value just like stocks did, we'd be in luck. The same goes with the stock market. Warren Buffett once wrote in his annual letter, "Only those who will be sellers of stocks in the near future should be happy at seeing stocks rise. Prospective buyers should much prefer falling prices. Whether a bear market recovers or continues to drag on, it doesn't really matter, does it? What does matter is how you respond to it." Thank you guys for watching. I'll see you in the next one.